I think you lived up to the billing, Duncan. Well done. I'm excited about that. And I appreciate that we were able to share that, because that's the kind of proprietary information that in general, if you're an entrepreneur, you never get exposed to. And hopefully we'll have more of that from the rest of our panelists. So with that, I'm going to introduce our next panel, which is really about what are the next categories that are going to be interesting. We focused a lot on stage and business model, but what are the next big killer categories going to be? Is it going to be light enterprise? Is it going to be healthcare? Is it going to be physical devices, et cetera? So let's get James Conlon up here, who's our moderator from Bullpen, and the rest of the panel. James, over to you.
Hey guys, I'm James Conlon from Bullpen.
That's good.
If I seem jittery, it's not because I'm nervous. I'm just still tingling from Duncan's presentation, so thank you for that, buddy. We'll get the panel up here in a minute. This is early stage panel. We're going to discuss sort of we heard a little bit about the Series A crunch from the investor or from the entrepreneur standpoint, so we're going to hear a little bit more from the early stage investors now with portfolios heading into that area. We've got Alex Mittal from CEO, founder of FundersClub. We've got Marcus Ogawa from Quest VP, Deborah Jackson from Plum Alley, Larry Marcus from Walden VC, and Michael Levit from Founders Den. So if you guys could just give maybe 2 sentences about your organization to introduce everybody, and we'll get started.
Hi, Deborah Jackson. Nice to meet you.
Sure, good evening. I'm Alex Mittal, FundersClub CEO and co-founder. We are the first online VC. In a nutshell, what that means is we invest like a VC. We seek venture capital returns. We do due diligence. We source deals. We co-invest with other VCs. But our capital actually comes from contributions made online, and notably from accredited individuals. And so look forward to sharing my perspective on today's topics and hearing from the other panelists.
Hi, I'm Marcus Ogawa. A little far. I'm Marcus Ogawa, managing partner of Quest Venture Partners. We're a Series Seed and Series A fund. We've done about 47 deals. I've been in venture for about 6 years. We do a lot of investments in mobile. That's kind of my focus.
Hi, I'm Deborah Jackson, and I wear a number of different hats. I am a finance expert. I was on Wall Street for 21 years, starting off at Goldman Sachs, and I worked in the area of healthcare technology. I'm an angel investor. I have about 12 companies in my personal portfolio. I am a co-founder of Women Innovate Mobile, which is a mobile accelerator in New York City based on building new mobile technology. And finally, I have an e-commerce company called Plum Alley, which is an e-commerce site as well as a funding site for female entrepreneurs.
Hi. Hi, I'm Rob Hayes with First Round Capital. We're a seed capital fund based here in San Francisco and New York and Philadelphia. I opened up the San Francisco office about 7 years ago now, which seems like an awfully long time ago. In seed investing years, and according to Duncan, I do about a deal a week, which isn't quite true. So,
Hi, I'm Michael Levit. I have a problem. I'm an entrepreneur. On the side, I am a managing partner at Founders Den, which is a co-working space for experienced entrepreneurs. Started it with a few other friends who are entrepreneurs. Really wanted to have a place that's one part clubhouse, where we get these experienced entrepreneurs who come together, and one part co-working space where we go to get stuff done. So although I don't have the finance background of those around me, certainly see a lot of deals and familiar with a lot of entrepreneurs.
Hi, I'm Larry Marcus from Walden Venture Capital, based out of San Francisco. We are sprout stage investors. It's a new word for you. We tap into the seed and the angel deals, but we're looking for the products or the technologies that have sprouted. So it really starts with a great demo, very product-centric approach to that initial screening process. So if you have a great demo, that's something that I'd love to see afterwards. And we lead Series A deals, or you can call them seeds or whatever you want for the terms, but we do priced rounds as a fund, not notes.
Okay, great. Thank you, guys. So we've had enough time now to see a lot of different models in the early stage world. We've seen the incubators, the accelerators, YCs making a big push. And then we've also seen time for all of that to adjust. YC is cutting back on class sizes. Some accelerators have shut down. We've got certain seed funds setting up dorm room funds and things like that. So what's working, what needs adjustment, and what do you see upcoming in the future?
So I guess I'll go first on this one. I feel like I'm representing the East Coast here. So we have a different ecosystem and different opportunities, I think. So in New York now, there are approximately 20 different accelerators or incubators that have started up in the last 3 or 4 years. And the accelerators that we're seeing are really focused on a specific vertical. So there's a FinTech accelerator, there's Kaplan Education Accelerator, there's 3 different healthcare specific accelerators. So I think we're moving in that direction to actually using technology and applying it to a very specific industry. So the accelerators actually have representatives from a specific industry who are working with the tech people. So it's a slight variation on a model. And I think our accelerator is very focused on quality, not quantity. So we're very specific. We pick companies, and if we don't have enough companies that we think are worthy, we simply shorten the class or decrease the class. So that's one thing I've seen.
I mean, I think any of them can work well if done right, right? The question is just, what are the, who's doing it right and who's doing it better? So, when we started first round capital, back in the day, there were very few seed funds, or hardly any. Now there's a lot, and so you have to keep improving the product, and that's how we see VC is it's a product. So there's our customers who are founders. There's our shareholders who are LPs. I think too many VCs see their LPs as their customers. And then there's what we built, which is a product. And the VC product for 30 years had been money and a smart person. And at least money and hopefully a smart person. And it needs to be more than that. And so you need to keep building things. And that's why you see, people beginning to build, communities beginning to build content products, beginning to build, all sorts of different things that can help companies be more effective in kind of getting that everyday stuff out of the way. With accelerators, and incubators, they all have the same formula, which is they've got a little bit of money, they've got some community, and they've got a Yoda, and so like the ones that are best at building community and the most compelling Yoda are going to win, right? And so, Alex can talk a lot about what he's working on in FundersClub. Well, we are an investor in FundersClub, and I think that they have, in their space, they have an incredible model. But there's lots of competition, so all of these things are going to be successful, but it's going to be a few players in each of these that are successful.
I also maybe challenge the moderator a little bit, but just the comment on incubators sort of getting smaller. If anything, I think that we've seen more crop up. I think those are some of the comments in the East Coast just now, and I see that here in the Bay Area. And even within Y Combinator, at least if you listen to the Yoda there, he's remarking that he aspires to double or triple where they currently are. So there's certainly action and aspiration to grow. And I think part of the reason that is because you're seeing the market recognizing that there is opportunity to access very high quality deal flow at the incubator and seed stage still. And people are trying to pursue that, but it does, I agree with what Rob just said as well about ultimately it does come down to a few key things, and whoever's best at those key things can win. And obviously we have a unique approach to that, but
right, and quality matters. I mean, at the end of the bubble that Duncan made a nice chart of in 2000, they started being referred to as incinerators and stinkubators because there were so many of them and getting through them didn't really matter. But obviously the model's been honed, and it's really important to realize that even if you're getting into one of those, and even if you are getting that initial capital, you have to really execute extremely well to get that product built, because that next round really is a tough one, and the good incubators or accelerators can help that process along.
So I think it's actually, if you look at it, it's a history of the case. If you look at something like Y Combinator, 6 years out, they made, they really kind of came out and started making a big impression. You see everyone step in to try to duplicate the process and capitalize on the opportunity. And so then you see a plethora of these different incubators and accelerators emerge. They all compete on the same model. Eventually they realize it doesn't function that way, and they're going to start competing against each other and eating their own foods. So because there's a limited resources, you see them start to evolve. And they start evolving over time into certain niches where they are either doing geographically or in a particular sector, and they migrate towards that and they polarize themselves naturally. And then the other ones will shake themselves out. So I think we're still in that process of evolving and seeing the evolution, which is also part of what's contributed to that Series A crunch, a lot of these deals coming out, because there's more people that are facilitating startups to actually move out. So I think there's still an evolution process, and we'll continue to see that shake out, but I think it's already starting to congeal. You're going to see it already with a lot of the incubators and accelerators focusing.
I think I think one thing too I've observed when I wear my investing hat, which is that when you go to the demo day for some of these accelerators, you go and you see maybe 10, 20, 30 different companies presenting back to back. And it becomes, actually, these companies are competing against one another, because as an investor, you tend to say, okay, which are the 1 or 2 or 3 companies look really interesting, and which ones do I want to follow up on? And so what I've seen is that sometimes there's a tendency for these companies actually to be competing. And so one of the things we do in our accelerator is we meet individually, privately, with investors all throughout the process, and we try not to emphasize one specific day where you have this, big drama and presentation.
To exactly that point, I think the point that we jumped the shark a little bit was recently San Quentin's demo day. When you had prisoners, I think it's wonderful that they were out there getting in front of technology. At the same time, they don't have access to the internet or applications. And so when you start saying, okay, San Quentin's having a demo day, maybe demo days are getting a little overplayed, just a little. So you have got more accelerators, more incubators starting up. As we climb up that cliff that you saw earlier, there continues to be more interest from different incubators wanting to get a part of that. And so you've got more and more Me Too's. You have a few brands that are starting to stand out, the Tech Stars, the Y Combinators, the 500 startups, and a few others that are looking really good. But these are really bundled services. And so I think the other trend we're starting to see is slightly disaggregated services. So if you start to say, what is the role of an incubator or an accelerator? Well, clearly there's money. Money's going to be an important component. There's some leadership so that you're going to get some help. We heard referred to a Yoda. And not just one particular person, but a network of people. You want a group of peers, and those peers are going to be people who are going to support you, who are going through the painful times that you are as well. There's the blocking and tackling of I need space, and some services that may be shared or may be recommended. And so when you start breaking down each one of those pieces, you start to say, oh, well, there may be some network of experts, there may be a Yoda, there may be funding which may or may not be separated out, several people here are in that business. And so when you start disaggregating those services, what you start to see is a co-working space can be one part of that. You start to see funding can be a separate part of that. A network of individuals who are going to help you come together can be yet a separate piece of that. So you're still going to have a few of these incubators and accelerators that are going to bundle all that up. Those are going to be great sources for discovery of talent. You don't want to go to 500 demo days. It's too painful. And so you're going to have a few that are going to be the winners, that are going to have brands that are going to be associated with, this is the place you go to the demo day to meet the talent, to have the network that have those things. And then you're going to have others that are going to be decentralized networks. And you're starting to see that pop up, and I think you'll see more of it.
I'd love to build on that, actually.
Just to say one last thing, though. I'd like to point out that probably the most important factor we've seen in success from a lot of these incubators and accelerators has been actually the investment banking aspect, where they're able to get their companies funded further and leverage their brand to raise the valuation for them at roughly 7%, which is exactly the traditional investment banking model. So that I think is actually probably one of the most unique things is they've adapted the investment banking model to the early stage startup with all the other full service suite of other things they provide.
Yeah.
So.
But how much of that do you think needs to come from an incubator versus coming from the correct funding source? You've got someone in funding who's going to help them
I think it's completely about amplifying the signal. And if you're using someone like Paul Graham, or 500 startups, and you're coming from India, it's a huge advantage.
Absolutely.
And I think that's the leverage that these guys are playing on their own brand, right?
Yep. Absolutely.
There's been a lot of help in financing, a lot of help with the mentor network and the people network and all of that, but there are now, as seed funds are proliferating and there's more competition for deals, there are new services being introduced, including stuff at first round, recruiting help, concierge services for research and things like that. Can you discuss a little bit more about sort of what's going on there in the competitive environment for deals and in the support for your brand and for your portfolio companies? And I know, Alex, you're also have been funded by first round, so you probably had firsthand experience with some of this.
Sure, I can share some of those experiences. Yeah, it's absolutely. I mean, first of all, I'll step back and I'll say I think there's this perception that and maybe a reality that some VC funds are offering these suite of services, value-added services. Could be marketing, could be hiring, recruiting, what have you, as just marketing for themselves, for the VCs. But I think you'll see the most successful folks in the business actually are doing it because they are approaching it very much like, hey, this is actually, as Rob said, it's kind of perfect. We approach it as a product. You know, if we're creating the best product, what's the best product we can create? Naturally, you look at who you're serving. On the one hand, you have your investors, your LPs, but on the other hand, you have startup founders. They have needs. You know, how can you help them with those needs? So if done correctly, that can be actually extremely helpful. And just as a very recent data point, not to toot first round's horn too much, but we just hired, for example, 2 folks straight out of first round's recruiting service for its portfolio companies. And then as a little, just a data point on our own network for FundersClub, we believe in that very strongly. We think that companies, when you're starting out, you don't have a lot of resources, you don't have a lot of open doors for yourself. Hiring, for example, key challenge, partners, customers, really serious business issues that help move things forward. Those wheels can be greased for real if people are there to help you who do have those connections. And so through, for example, with FundersClub, our network of people, we have a very big network of people, we've been able to literally get key people hired at our portfolio companies to get people, to get companies customers and partnerships and coverage in the media and so forth. So it's definitely, when done with the right intention, which I think is actually serving the entrepreneur, serving the company, it does actually help. Whereas if where it's perceived as, hey, we're just doing this to look good, so we can get good deal flow, I think that's where people don't actually deliver, and where maybe people start to actually raise the questions you're asking about, like, how valuable are these things?
I mean, the genesis of everything that we do began 7 years ago when we had our first CEO summit, and we did the CEO summit that it seemed like, we were brand new in the business, and every other venture capitalist had a CEO summit where they would have people come and talk to their companies, and I'll never forget this is when Twitter was brand new, and a friend of mine was on Twitter, and he tweeted out, he was at his CEO summit for another VC, and he tweeted out, he said, being motivated by a blue angel. And I thought, oh my God, that sounds awful, right? I mean, it might be really cool, but I'm not sure how that's accretive to his business, right? And so we decided it wasn't going to be about that. It was going to be very functional and very about building culture and hiring, things like that. And we put together this session that I thought was great. And at the end of it, we had it over at Quadrus, because we could fit our companies in that room then. And afterwards, CEOs came up to me and they said, this was really great. We really enjoyed it. But the time that I really enjoyed was the time spent with the other CEOs, and catching up with them and hearing their stories and that sort of thing. And we begin to scratch our head and think, oh my God, when we always say that being a CEO is the loneliest job in the world, but it never dawned on us that we could help make it less lonely. And so at the next CEO summit, it was much more about creating time for the CEOs to spend time with each other. And so it was listening to them where we built our first product, which was essentially a way for there to be a sense of community among the CEOs that lasted throughout the year. It wasn't just at the CEO summit. And then we listened to them again, and they said, CEO may be the loneliest job, but CTO is the second loneliest job. And those guys are so nerdy, they don't want to talk to anybody anyway. right? And so they said, well, why don't we do another group for CTOs, which I don't think anybody else does. And that was, the CTOs were like, oh my God, this is great. And then we started talking about building culture and things like that in an engineering organization, and they're like, wow, no one talks to us about this kind of stuff. And then we listened to them again, and we said, what's your biggest problem? They're like, well, hiring. And so then we put together a hiring function. So it's you know, I back when I did something useful for a living, I was a product manager, and my job was pretty simple, right? Is you go out and you talk to customers, and they tell you what they want. And then you build it, and then you give it back to them. And they're like, this is great. Okay, so I get this. Now I understand how VC works, right? And so that's, you know, that's it's all we're doing. It's not that difficult, but it seems to be, you know, relatively new, and I think a lot of the companies that we work with like it.
We've all right. We've heard a lot about the Series A crunch already, especially from the entrepreneur standpoint. But times aren't too easy for investors with seed portfolios either. So, what, from an investment strategy standpoint, what are you guys looking at in terms of sort of escorting your deals through a difficult financing environment and maintaining portfolio strength through a time like this?
Tell them to get shit done.
Well said.
Good companies will always get funded, fundamentally. But the other thing probably we're telling them much more to focus on is revenue.
Sure.
That is an absolute. I mean, as long as you're generating revenue, you're reducing your burn. You're more likely to raise your fundraising because you've de-risked the model a little bit more. Yeah. So we are definitely telling them and guiding them more or less to increase the revenue opportunities.
Have you noticed the sort of the goalposts changing from the Series A guys, either in form or distance? Like, are they looking for bigger revenues? Are they looking for different, you know, revenues instead of user growth or, you know, characteristics like that?
Yes, absolutely. Yeah,
what do you
because
say?
the Series A guys cannot play the Series B guys because the Series B guys vacated to either Series A or Series C.
Sure.
They went up stack or down stack based upon how terrible their performance was previously. So because of that, you've seen now this gap in between where, you know, Bullpen, for example, is trying to take advantage of that. But as a consequence, you've also seen the Series B guys who are still doing Series B now stepping in and demanding a higher opportunity. So the Series A guys are in the same category now because they need to bring that company to that Series B. So they need to be able to have it in a position where they're able to take it from point A to point B correctly. And that means that they already have to have de-risked the business model quite considerably more than in the past. Precisely for that slide that Duncan showed, that it's much, much cheaper today to start up a company.
As a data point, at FundersClub, we mainly fund in the seed round, and 25 of 31 of our investments of our companies are revenue generating at that stage. And so it's sort of, I think it echoes what Duncan was saying earlier, what you just said here. Very much so. There's this because of it's either the Series A crunch or it's the shift of what we call different stages of a company. And so there is this stage now that's becoming much more common post an initial seed round, pre and A, which has become more like a B, that's available.
So one of the trends that I see on the East Coast is there's a huge growth in the number of angel investors. So back in 2008, New York accounted for roughly 12% of all angel investing. This year it's up to 22%. So there's a huge growth in angel investing, and the angel investors there look more like Series A investors. So they may come together as a group or a syndicate and invest up to $1 million in a company that's pre-revenue. If you look at Pinterest and some companies like that that came out of that kind of ecosystem, it's been fascinating. So it just feels like that whole East Coast is shifting, and more people are trying to get into the game. More people are, you know, putting up their money. So it's, I think it's a little bit different there compared to here.
I'll just echo what everybody said there. I think there's more pressure to get out of the gate, show what you've got. But the little tweak that I would say is that it's not just about revenue. If there is a path towards revenue, that's fine, but get out there, prove your model, and show some scalability. So get some traction, get users on it, and show that with some expense you can grow that user base or have some ideas of what it's going to cost to get more users. So start to get some arms around the sales and marketing function, as well as just getting them eating the dog food, getting users using it. But it's a little less sensitive necessarily towards revenue, as long as there's a pretty clear idea in your business of how you're going to get to that revenue. But again, a little bit of focus on sales and marketing in addition to just getting people using the product and starting to enjoy it at some level.
I would comment on Mike's comment, like from a founder point of view, it's important to be, if there's founders in the audience, to be talking to your customer, having a close connection to what people actually want and building product that meets that demand, and that's way more important, honing in on that. And then how do you get to the next stage is way more important than a growth curve in numbers. But as far as where the money is it's when you've done that and also sort of launched and started to generate real cash flows.
So I'm not always looking for revenue. I'm really looking for to see if that product or the technology can really gain mass market adoption if it has that broader capability. And there's kind of this pyramid of users. How many users are there? How engaged are they? And then how do you monetize them? And if you focus on monetizing them or getting yield too early, you can actually choke off the user growth. So if it feels like it's going to be clear that the revenue opportunity is there, or there's a theory that could be interesting, then I think that's something that's very fundable. But obviously, everybody loves it when you don't need the money. And if you're profitable, I definitely want to write a check also. I think the revenue thing can be a little bit deceiving. I do also love little case studies. If you can nail a small market, if you can nail like one bar and there's 50,000 bars, if you can nail one key small city and there's going to be another set of those case studies mean a lot. And those early user groups matter a lot. How do the first 10 users behave? Well, if you have 100 users after that, they're probably not going to behave all that differently. So nailing those early cases. So I think there's other leading indicators as well, but revenue is certainly awesome. And some businesses, revenue is the only way to judge them.
I'm hoping to have one or two questions from the audience toward the end, but before that I want to talk about the Jobs Act just a little bit. SEC just voted to lift the ban on general solicitation. That could do a whole number of things. It could do almost nothing, but I'm sure there will be a ton of opinions here. But does that democratize deal flow? Does it open up a danger of having deals with 80 angels and no real institutional deep pocket that can carry them through or mentor the company and no vested interest to bring them the whole way? What are your thoughts? What does that do to the environment, and what's the future look like over the next few years?
In a fertile environment, everything grows, including weeds. So eventually it needs to be pulled out and cleaned up again, but time will tell.
I have another, to actually generally solicit, a company needs to do a very specific type of filing. And so we hear the headlines, the ban has been lifted, but actually no company today can generally solicit unless they shift their legal structure to a type of a 506C instead of a 506B offering. And so it's sort of, there's a lot of legal nuance at play. I think one thing that most people, though, would agree with, if this could actually happen, is there's almost like a limitation on free speech right now in the context of the business we're in, which is if you're a company raising capital and a reporter asks you, when are you raising a round, are you raising a round? You're not advertising, you're just stating a fact. And you're not allowed to do that today. It seems a bit strange, it seems a bit bizarre. And if you ask any founder who's been in that position, either because their round got stopped early because a reporter accidentally reported about an ongoing round or whatever, they'll tell you that was like a very annoying experience. So I think that little piece is maybe something most people could agree on, that we should be able to talk about what's actually happening. But looking beyond that, I think let's say it does play out in a way where it is actually implementable, companies start jumping aboard, start adopting general solicitation. Okay, that could be good for one given company, but if every company is doing that, the net effect for all investors is you're going to get a lot more noise, you're going to get a lot more messaging, either just through the media or through actual advertising and marketing once that becomes legal. And so, to the weed comment, I mean, certainly there'll be more weeds, right, that are in your face, that are there, and separating out what is quality from not quality becomes all the more important. And you see in the public markets a level of transparency that you don't see in the private markets today. That's evolved in response to that. So you have rating services, you have analysts who study different industries. That doesn't exist to the same level in the private market. And I think if we were to project forward, what might happen here is you'll just see that void filled to try to mitigate some of these issues and try to distinguish signal from noise.
And I can also see, having spent my first career on Wall Street and doing a lot of offerings, public and private, and thinking a lot about disclosure and what kind of information investors really need to make a proper investment decision, and thinking about it also from an investing angel point of view, you know, I can see a scenario where there's a lot more work required on the part of entrepreneurs to explain their company, to educate potential investors. And you think about what you have to go through when you meet with angels or VC firms, and how many meetings and how many different scenarios. And, you know, if you increase and bring that out to the general public, there's a possibility that you know, what you present about your company is going to have to be a whole lot more complete and sophisticated. So that I think is tricky. And I really think, being an investor myself, and, you know, made some good investments, lost some money, you know, I think most people that aren't professional aren't really in a position to do that. And I just fear that some people will think, oh, this is my chance to invest in the next Facebook. And we all know on this panel you lose a lot of money. You don't always make it. So, you know, to think inexperienced people will be making these guesses is, you know, kind of scary, I think.
But they'll fix that with laws too.
With the lawsuit.
And I mean, I'd argue too, just to, this is obviously native content for you as well, but quite literally what Deborah just said is something that we ourselves experienced as former founders in our previous current lives too as well. You know, raising capital from individual angel investors can be quite difficult. The best founders do seek out venture capital. You see this playing out time and again. And so if there's a way to both capture, you know, capital that is there, that actually a big, you know, $500 billion or more, some people estimate, without the overhead and in a way that's responsible, that could actually be a very good thing for us all. And so that's something that we've really focused on. How do you let the legitimate startups rise above the noise, and how do you make surface opportunities that are more promising to investors, without them having to bear too much burden of the process Deborah was referring to.
All right, I got to ask just a quick response on deal flow before we go to the audience. Are entrepreneurs getting sort of discouraged from this current financing environment? Are the ambitious, you know, lean startup seed stage guys still excited to be starting new companies? Is the seed glut still coming, or has everything cooled off? Is talent cycling back into the ecosystem into more stable companies, or what have you seen so far?
I don't think founders are motivated by fundraising, at least not the best ones that I know.
Sure.
Yeah.
And, you know, we saw earlier the data from Duncan that, you know, we're still going up the cliff. I know for us, we're seeing more deal flow than we've ever, seeing more and more founders who are motivated, who are excited. The seed money keeps coming in. And as you get the FOMO, as we heard earlier, you're going to have more and more people who have made some money, and that further stokes the angel investments, that further keeps this cycle going for a little while longer. The other piece that we didn't talk really about here is the acqui-hire. And so if you think about it from a smart founder who's really thinking about, do I want to go get a job or do I want to start something, it comes down to, it's always a little scary to really go and walk without a net to catch you. At the same time, an acqui-hire, although it's not a great place to fall into, it's still a place to fall. And as long as there's big companies that are on buying sprees, it's going to help continue to keep this cycle going, I believe.
All right, we should have time for one or two questions from the audience. Yeah, go ahead.
Is the revenue model looked at differently at the different? Is the revenue model looked at differently between the seed and the first stage and other stages?
Yeah, completely. I mean, the scalability is very different, right? What you're looking for is with seed is just to see if there's an opportunity to have a business model that generates cash. I think with Series A, what you're looking for is scalability now, whereas traditionally it was more Series B, where they were looking for that growth opportunity. Is this a model that can scale to become, you know, a very big revenue model? So you're seeing that actually downgrade more into Series A, and in some occasions, people already big to get into Series C. So yes, it very much differs on different rounds.
Yep.
Hi. We talked about the current model being, for accelerators, being community, a bit of money, a Yoda, etc. I still would like to know, where do you see it heading towards? Because we talked about the evolution in the past, but what's the evolution in the future?
So I think for accelerators, at least what I see on the East Coast, is that they have huge value add because they not only give these companies a small amount of money, they relocate to New York, but to me it's mentorship on steroids. So for a small period of time, you have a small number of companies. I'm not talking about the big companies, but you have these companies that come together, and I participated in it, I witnessed it, where they go from an idea or maybe a beta of a product to within 3 months actually having a legitimate product. And there's a lot of changes that occur during that time. I've seen companies and products completely change, but I can see the value from day one versus when they come out. And I think the reason you see so many accelerators springing up is that I think there are very specific things that you can get out of an accelerator where I think it's very hard for you to do it if you're a standalone company.
I'll take that one step further and say I think you'll see 3 different versions really come out. One is something that's really verticalized. So then you're going to have people that are going to come together that are going to self-reinforce the network within that vertical. Number 2 is almost the super accelerator because they're going to package together so many things, and that's what Mark was saying earlier of you're creating a brand, and that brand is going to be so powerful, and it's not just a brand, but a scope of services that all come together. And that's going to be a really important piece for discovery of talent. Someone who maybe that's not on their first startup, in some cases yes, but someone who's got some amazing horsepower, has done some interesting things, and this helps escalate them to the next level. The third category is folks who have a little bit better network, who maybe have come out of an accelerator, had an exit, and are a little bit of a different level. They still want to be around a group of different folks that are going to be a network, that are going to be self-reinforcing, that are going to have co-working, that are going to have a variety of different things. That may be a little bit roll your own and disaggregated services, but I think there's a class of services that fits there as well.
Another thing, a trend that I project happening is we may start to see international accelerators and incubators that conventionally have still been in the process of finding their way. The evolution we were talking about really start to deliver. That's something that at least I hope happens, but you start seeing signs of that.
That's already happening for sure. We get more and more people knocking on our doors in different ways saying, you know, can we take your model to XYZ country? Can we leverage the brand that you guys are working on creating? Different models of, hey, we want to have an anchor tenant that's some large company that's going to give free space, a shopping mall, we had literally someone offer us an empty Mervyn's store that they wanted to take somewhere. That was in the U.S., but take that similar kind of model abroad and say, hey, can we open that up for much broader audiences?
Well, it's time to conclude, but let's thank the panel.